Let's go. Hello everyone, welcome back. My name is Summer. Today we will introduce the topic for equity market 2, equity and investment. To begin with, thanks to the UNSW Sydney and Dr. Evelyn Lai, I would use this PPT for my preview and review of this class. So let's begin. The class is FINS, Finance 5512, Financial Market and Institution. So let's begin. First is the investors in the share market. So the learning objective is, in this chapter we will cover the following: consider the role of the investor in the share market, appreciate the range of investment choices available, and understand the associated risk, understand the importance of taxation in investment decision, describe indicators of financial performances, explain the factors influence share price. So let's move on. First, the investor. Investors buy shares to receive return from dividends and capital gains or loss. You can see that. The difference between on the left hand is the function, the logic of the date, and on the right hand is the logic of equity. It saves dividends and returns variable, and the maturity is independent, and the redemption is none. The core income on asset is based on the residual value, and the management can influence the return, and the taxation is non-deductible. The share market offers a wide range of security types. The share market offers a wide range of security types to investors. In the last week, we introduced the six types of equity fund alternatives. So, considering the share market investment, the returns can be in the form of dividend received and or capital gains. And the risk can be divided into two types. First is system risk, which means the factors that generally impact on the share price in the market. The unsystematic risk is factors that impact especially on the share price of the corporations. You can see that system risk is the general risk in the market, and unsystematic risk is the risk special to your company. That is the detail. System risk arises from factors affecting the whole market, and unsystematic rising from firm special factors can be eliminated in a wide disparate portfolio. Yes. And a diversified investment value contains a wide range of securities that diversifies with most of the unsystematic risk of the individual securities. Investors will not receive high return for unnecessarily bearing unsystematic risk. Will not receive high return for unnecessarily bearing. What does that mean? Investment will not receive higher returns for unnecessarily bearing unsystematic risk. Yes, that means more unsystematic risk, more return. Correct? I failed to pronounce it. Sorry, it's my bad. Unsystematic. The remaining risk is systematic risk, which is measured by beta. The beta is a measure of the sensitivity of the price of assets relative to the market. Yes. Expected portfolio return is the weighted average of expected return of each share. Portfolio value dividend depends on the correlation of payouts of security within the portfolio. The share markets, the security lists on the stock exchange are categorized into industry group, allowing investors a choice from a range of economic systems. The Australian, so let me see the picture. ASX, you know that what I mean, is the Australia Stock Exchange sectors. So stock market index tracks the performance of a group of stocks, provide a snapshot of the market trend, investors' sentiments, and assess with investment strategies like the Dogners and the FX fix index in UK, SP Standard Poor Dow Jones index in US. Yes, investors may take one of two approach, and considering investing methods, there are two approaches. First is active investment approach. Portfolio structure is based on the share analysis, new information, and risk return preferences. And the passive investment approach is the portfolio structure is based on the replication of the specific shareholder index. Replication. Yes. Investors also need to consider other factors in constructing the share portfolio, like the risk versus return, income versus capital goals, investment in time zone, and the domestic and international share. Domestic. Sorry. Buy and selling shares. Direct investment in shares means investors investor buys and sells shares through a stockbroker, can be the discount broker or full service advice broker. Indirect investment in share is investor purchases units in the unit trust or managed funds. Yes, the direct investment means the investors participating in the capital market, first market, or primary market, or second market. Indirect investors means the indirect investment means the investors join the markets by the third parties. Taxation. There are two widely used taxation systems: the classical tax system, prior to 1986. Companies pay tax at the corporate level on their income. Shareholders pay tax at their personal rate on the dividends that are paid out. The imputation tax system, post imputation. Company pays tax at the corporation level on their income. Dividends are paid out with franking credit representing the amount of common tax that have already been paid. Shareholders pay tax at the personal rate on the sum of the cash dividends and the franking credit. I don't know what the franking credit note means. So let me see the detailed example on next page. Company pay tax. So the same thing. They have the company pay the same level of tax. The same whether the company pays the same level of tax whether the classical system or the imputation system. But the classical system personally, shareholders pay tax at the personal rate on the dividends they are paid out. Dividends are paid out with franking credits. The key question about the difference is the franking credit. So let me see an example. If the taxable income is 100 on classical system, the company pays 30 and the remaining is 70. The shareholder level, the cash dividend is 70, the taxable income is 70, and the personal tax liability is $31.50. So it's not is 30 times 45% is $31.50. So the personal tax paid is, so the after tax income is $38.50. So if you use the imputation amount in the corporate level, it's the same, but for shareholder level, the taxable account is 100, and the personal tax liability is 100 times 45%, but there is a franking credit of 30 in the company level, so just 15. So just 15 amount, so just 15. So 15 is taxable for personal tax. So the amount, the remaining is 100 minus 30 minus 15 is 55. Capital gain tax need to be paid on shares sold at a price on profit 50% if holder at least 12 months in Australia. Capital loss can be used to offset capital losses can be used to offset capital gains. Is similar to the UK. And the pricing of shares, we need to know that share price is mainly in function of supply and demand for the share. Supply and demand are influenced mainly by information. So share price is considered to be the present value of future dividend payments that the company is expected to pay to shareholders. So it's just similar to a previous to our last week's knowledge about NPV. It's just same function. So valuing a share with a constant dividend, valuing a share with a constant dividend growth, the two methods. New information that changes investor expectation about future dividends will result in a change in the share price. And other factors influence share price is cumulative dividends and its cumulative dividend shares. Dividends are payments made to shareholders and expressed as cents per share. Dividends are declared at one day and paid at a later specified date. During a period between the two dates, shall have the future dividend entertainment attached and traded cum dividends. Once the dividend is paid, so the share price will drop. It's called the ex-dividend, cum dividend, ex-dividend. Theoretically, the share price will fall on the ex-dividend date by the size of the dividend. Correct. And second is bonus share. Bonus share is used where a company has accumulated reserves. It may distribute these to existing shareholders by making a bonus share or adding a bonus issue or adding shares. As with dividends, this will be a downward adjustment in share price when shares go ex-bonus. As no new capital is raised, there is no change in the asset or expected earning of the company. If a bonus 1 to 4 issue is made by the company, the cum bonus price is 5, making a value of 4 cum bonus share $20. Market price is 4 times $5 is $20. Theoretical value of 5x share 5x bonus share is $20 well. So the theoretical value of 1x bonus share is $4. Drop by $1. Third is share split. Invoice division of the number of shares on issue involves no fundamental changes in structure or assets. Involves no fundamental change in structure or asset value of the company. Theoretically, the share price will fall in the proportion of splits. Let's say an example. If the 5-for-1 split is made by a company, the split per share is $50. The theoretical split share is $10 for the 5-for-1 split. That means the share price will be divided by 5. Yes, correct. And the fourth is pro rata writing issue. Investment involves the increase in the company's issued capital, typically issued at a discount to market price. Theoretically, the market price will fall by an amount depending on the number of shares issued and the size of discount. If the 1 to 5 rights issue is priced at 88 cents when the market cum right price is $1 for the company. The cum right share price is $1. Market price for 5 human right share is $5, then plus a new fund from 1 to 5 issues is 88 cents. So the market value of the 6 X right share is $5.88. So we can know the theoretical X right share price is $5.80 divided 6 is $98, correct? 98 cents. So let's move on to the next part of today's share price movement. So the learning objective of this chapter is explain the rule of fundamental analysis and technological analysis in forecasting movements in share price, discussing the theoretical concepts that form the basis of the random walk hypothesis, consider the implication of the effect market hypothesis and the behavioral financial hypothesis. Behavioral financial hypothesis. So we need to understand 3 hypotheses. First, the fundamental analysis top-down approaches. A share price is determined by supply and demand of the company shares, especially in secondary market. Expectation of bad company performances causes investors to sell this price, increasing supply and reducing the share price. Expectation of good company performances causes expectation of good company performance causes investors to buy their shares, increase demand and increasing the share price. So the fundamental analysis consider macro and macro. Micro and macro factors that impact upon cash flows and future share price of various industry sections and firms. Macro factors include interest rate, economic growth, business investment. Macro factors are firm specific and relate to management impact on company performances. The top-down approach considers several macro factors. And following identification of the best economics and industry sectors for investors using the top-down approach, the bottom-up approach can be used to identify the best companies within this. The bottom-up approach considers micro factors using ratios and other measures of the firm's financial characteristics and performance. Accounting ratio that assess a company's capital structure, liquidity, debt serving, profitability, share price, and risk, observing a trend and making comparisons with firms in the same industry. Additional information on key management change, corporate governance, and strategic direction, etc. Next, we introduce the technical analysis. Technical analysis explains the forecast share price movement based on the past price behaviors. It involves using characters, so it involves using charts of the securities historical price. So our level to focus is future trend. Chartists believe trend and non-random and can be exploited for profit. Technical analysis uses a variety of indicators such as moving average and chart pattern, candlestick, triangles, support and resistance level. Oh, these are very professional terms in the stock market. I've learned that before, but I forgot that. Maybe I can watch some video to record it. Yes, it's only 20 minutes. It's very fast. So let's continue. Excuse me. Let's continue. It assumes markets are dominated at a certain time by mass facility for which regular pattern emerge. the random walk hypothesis. Let me introduce our first hypothesis. Share price is assumed to be formed by investors' expectation of future cash flow. Price will change in response to new information. Since information arrives in a random fashion, stock market adjusts in an unpredictable fashion. Random walk. Random walk hypothesis. Each observation is price series is assumed to be independent of the previous price. There is an equal possibility that the next price will be. There is an equal possibility that the next price will move up, down, or remain unchanged. Wow, it's make no sense. It makes no sense. The random walk hypothesis is little okay. Just let's go. So we'll introduce a second hypothesis about the effective market hypothesis. The effective market hypothesis process that markets are information efficient if price adjusts immediately to new information. Former 1970 identified three-fold level of market efficiency based on the type of information that is impounded in stock price. The effective market hypothesis price that the markets are information effective if price adjusts immediately to new. Sorry, these two are the same, but the difference is that there is a workshop, and the effective market hypothesis is weak form. Price reflects all information contained in the record of past price and volume. The semi-strong form and the strong form. Traders might have access to new information and begin to review that information by the effect on price, perceiving a trend. Other market participants may track in the attempt to profit from the new information. This speeds up the impounding of the impounding. This speeds up the impounding of information reviewed by the initial pricing movement. Subsequent movements after the initial information has been impounded will be random. The effective market hypothesis. The second stage is a semi-standard form. Particular prices fully reflect all public available information. A semi-strong form effective market might also be weak form efficient because historical price and volume are publicly available information, and the access price reacts immediately to the relief of any new information that is made public. And the final stage is the strong form. All available information is fully reflected in current prices. A strong form effective market must also be semi-strong and weak form efficient because public available information as well as historical prices and volumes are a subset of all available information. Asset price should reflect private information or information known only to a select group of participants. Finally, is the concept about the behavioral financial hypothesis. Differences observed in market price and those expected under the EMH because people are not rational investors. It's a theory about is a hypothesis that the investors are not rational enough. Investors do not always process information correctly or may make inconsistent or suboptimal decisions. This results in market price that differ from fundamental values. Behavioral financial is based on psychological principle of investor behavior. Prospect series of confidence loss, aversion, framing, representativeness, cognitive cognitive dissonance, cognitive dissonance, reference point independent. These are factors that influence the behavior of investors. So the conclusion is that there are many factors you should consider when investing, and so in this class we introduce the factors investors should consider when investing, what's the in factors. So we introduce the two types of investment. Yes, we introduce the risks and the passive and active investing method approach, and the tax influences. And the calculation of the different factors influence the share price and how to calculate it. And then we introduce yes, that's correct. Factors active in the passive taxation into share price, and it's another way. Different methods that influence the share price, and the way to calculate the X right price, theoretical X price rights, and then we introduce a fundamental analysis, bottom up, top down, bottom up, pros and cons, technical analysis, and theoretical on change of share price. No, I think it's the behavior hypothesis, and we introduce the random hypothesis, random walk hypothesis, effective market hypothesis, 3 stages. Yes, that's all about week 4. Next week we'll go to the debt market. So half an hour. Let's go. Bye.